You're looking at a chart of Zynga stock. It was battered yesterday, bouncing a little bit today. You can see that up almost 3%. We're going to find out what's going on with Rex Crum with MarketWatch out in San Francisco. Rex, thanks very much for joining us. Let's recap yesterday's battering.
Well, yesterday, like you said, it got battered pretty hard, and over the last 2 days, it was down about 17%. And a lot of this is related to the company's ties with Facebook. You know, a recent report came out saying that growth was, with Facebook was slowing down. Users are, not growing at levels that they have been before, and because Zynga is so dependent, so closely tied to Facebook, whatever happens to Facebook is going to have an effect on Zynga. And I think you're still seeing a bit of the residual effect of the lockup period from the IPO, from Zynga's IPO, which ended earlier this month. 300 million shares went on the market. That had an effect as well too. But we're seeing a little bit of a comeback today.
The comeback today is to do with a series of analysts who've come out and said, it's not as bad as you think. Explain their thinking behind this.
Well, the main one was Evercore Partners analyst Ken Sena. He raised his rating on the stock from sell to the equivalent of neutral. I mean, at least that's something. But the feeling is that, this company has probably bottomed out as far as it can go valuation-wise. And there are still opportunities for it, especially in the mobile gaming sector. Zynga's exploring new avenues, ways so that it's not necessarily so dependent on Facebook. And again, the analysts are just feeling like, things aren't really as bad as they look. They're not great, but, give these guys a little bit more faith right now.
And part of that is, can they get on these mobile devices, as you mentioned? And I guess the question is, can they? I mean, mobile is the space that everyone wants to crack. Can they do that? I mean, the big game companies couldn't seem to crack Facebook, and Zynga came along. Is it going to be somebody else comes along and cracks the mobile space? Yeah,
that's the big question, especially with everything involving the iPhone. Has its game center, the iOS 6 upgrade coming out here. Zynga's going to be looking for ways to monetize mobile games through there, because there's just the facts of the facts. There's so many people are on mobile devices more. It's a greater opportunity to reach out and try to make some money that way. So if they can do something in that direction and again get less dependent on Facebook, it might help them out a bit.
Now, one of the things that we know about Zynga stock, and let's focus on the stock part of this here, is that it's now trading at $5 a share, around there, and that's a price at which a lot of institutions are not allowed to buy it. But we also know there's a lot of retail interest in this stock, a lot of retail holders of it. Is that bad news for the retail holders, because the institutions may just have to dump the shares because of the price?
It's not necessarily a good thing. I mean, let's face it, when the institutional guys, they have a big sway over, any company's performance on the market, because they often have such big holdings there. And Zynga's now roughly around half of what it was at its IPO price. It's down about 65% from its high this year. So there's been a little reason to think like, it's going to turn around much, and the institutional guys are probably getting more and more wary. And it makes it a little bit harder on the retail investor who might be thinking, there's an opportunity here.